Good morning, everybody. Thanks very much for joining us here at Savills for what will be the third annual European Logistics Real Estate Census. We're joined as well by the live stream, so thank you to Matthias at the back there, and thank you to everybody joining us online. If you are joining us online, you've also got a questions area on the right-hand side of the screen, so please put questions and comments in there, and I'll try to pick those up as well as the questions that we've got here in the room. And also, additionally, thank you very much to everybody for being here on a Monday morning. Excellent, thank you everybody. It's going to be a presentation from Kevin, first of all, just to highlight some of the areas of the census. There'll also be a kind of connection a little bit with previous censuses, so we'll be able to get a view on what's happening and where the market's travelling. And then we've got a super panel coming up with Phil Redding, Niek, Poppelaars, James Markby and Daniel Berry. So really interesting session, designed to be interactive, so if you've got thoughts, comments, don't wait. Please shout them out, stand up, whatever is necessary to make sure that we hear them, because we want to hear what your thoughts are as well. And because we're all in person, we're going to applaud ourselves for being here, and Kevin, and at the same time our speakers as well. Kevin, over to you.
Good morning, everyone. I've never had two lapel mics at once and a lectern mic, so three mics picking up what I say. I better have something good to say on a Monday morning. So, as Richard said, this is our third annual logistics census across Europe in partnership with Tritax, Eurobox and our partner Analytiqa. I'm going to spend 10-15 minutes just giving a bit of an overview, what's going on in the market, some of the key points from our census, and then we'll give over the balance of the event to the Q&A. So don't be shy with questions for our expert panellists. You'll get a copy of the slides afterwards, of course, and we're happy to. Very important. We're also launching a report that goes with this today as well. So you'll be getting a copy of the report in your inbox as well. So when I was preparing my slides for this, I sent it through to a couple of my agency colleagues, and they said, "Yeah, Kev, it looks great, but there's not enough pictures." So I thought, well, okay. So I went back to my slides from Shedmasters, which was an event we held in Barcelona earlier this year. And I dug out this slide again. This was my opening slide for Shedmasters in Barcelona. And this was the Europe's tallest roller coaster, which was just 10 minutes down the road from the event in Barcelona. And I said at the time, where are we on this roller coaster? And probably what we were thinking back then was just over the precipice at the top in terms of that roller coaster. Where are we now? Probably a little bit further down, if that makes sense, in terms of the momentum and sentiment that's coming through in the market. And I'm going to give you a few slides of that sentiment that's come through from the census. And I just thought as well, it's worth visiting, where we were this time last year. And again, this slide I presented at the second census this time last year. And we had this, this view that we had, headwinds in the market and tailwinds. And the view at the time was that, yes, the headwinds are strong and they're getting stronger. And the tailwinds that have propelled our sector forward for the last 10 years, arguably, whilst they're still there, they're probably being balanced out by the headwinds. And if we now move on to a couple of economic slides, just to set that scene, before moving on to the market updates and the census, I just thought this is a really interesting slide, and I've said this point so many times before, and I'll say it again. Around 2/3 of occupier demand comes from the retail sector. There are certain countries and certain markets where that doesn't quite hold true, but by and large, at a pan-European level, 2/3 of occupier demand is related to retail in some way, shape or form. So this, for me, is a really interesting slide looking at consumer confidence. And three indicators here: the financial situation of your own household, the economic situation in general, and then your unemployment expectations. And historically, those three things were pretty much aligned. COVID comes along and shatters that correlation. State support, the government has their arm around us. People feeling, yes, we're okay, but the economy, not necessarily as resilient. And I just want to draw your attention to the red line, the yellow line here, which is people's view of the economy in general. Trending upwards as 2023 has progressed, a good sign. Relate that back to the 2/3 of demand that comes from retailers. And again, the financial situation of the household, which is the turquoisey light green there. And again, that's trending upwards as well. Not pronounced, but definitely there. So again, the consumer is feeling kind of okay, in all of this quagmire at the moment. And that, generally speaking, has to be relatively good news for our sector as well. And again, more impacted on capital markets. This is inflation across Europe, and you can see those big peaks, and coming probably Q3 2022, and then varying degrees and varying paces of falling across Europe. But it is clear to see that the inflation nadir has been reached, and different markets are now performing differently in terms of where that's going to settle. Quick chart just on occupier take-up. This is our data set for logistics take-up across Europe. And what you can see here, two blockbuster years, 2021, 2022, 35 to 40 million square metres of new leases signed for warehouse space across Europe. 2023, Q1 actually at a pan-European level surprised me on the upside. Actually, take-up exceeded what I thought it would get to. Q2, slightly more muted, but combining the two for half one, we are just around 13.2 million square metres across Europe, and that is broadly in line with the pre-COVID average for take-up. However, if we start to split this out by market, it's a very interesting picture. If we look at, and this chart looks complicated, it's not really. Let me explain what's going on. All we're doing here is we're looking at each market, and then we're looking at the take-up, comparing it year on year versus the 5-year average. And the year on year is the lighter colour, the 5-year average is the darker colour. We've highlighted the European region as a whole with the red box. You can see the UK, based upon those comparing with average metrics, is the worst performing market in Europe. Then, if you look across at the markets that are performing relatively well compared to their averages, Dublin, Italy, Budapest, Romania, these markets, more secondary markets, but again, coming from a low base, but you're seeing occupier demand and exceeding those pre-COVID averages. Again, just a little bit on vacancy. For me, vacancy is always one of the most important indicators in the market. Low vacancy correlates directly with higher levels of rental growth. If we can get comfortable with where vacancy is, where vacancy is heading, that will give us a real good indication of what rental growth we expect to achieve, on top of the normal indicators, the macroeconomic demand driver indicators as well. The red dotted line is the pan-European average. And again, you can see that this varies from 8.25% right down to 2%. But the pan-European average is coming in at 4.7%. Again, trending upwards, but at a relatively slow pace, all things considered. In the UK, where we've got the best data and the most the longest time series of data, we've observed that rents have never increased when vacancy has been above 12%. So there is a huge level of vacancy needed to get even to double-digit vacancy levels. So for me, yes, vacancy is trending upwards, but not at a level that would concern me, particularly when it comes to rental growth. Okay, moving on to our census. I'm going to pull out some key points. As I said, our panellists will be discussing and reacting to some of the key points in the census. You'll all be getting the report that goes with it. Interestingly enough, we had just over 250 responses to the census this year. Not as many as previous years, which is a head scratcher for all of us really, because we thought people may have a little bit more time on their hands to complete the census. But nevertheless, this is an issue across the board, and it still gives us some really interesting results. Particularly if you look at the occupier base here, over 100 responses from occupiers, and again, pretty neatly split between retailers, manufacturers, and logistics companies. So again, we're getting a broad church of views that are feeding into the results of the census. Interestingly here, we asked people, how do you view business conditions when compared with the last 6 months? We've got investors, developers, landowners, agents, consultants, and occupiers. A real mixed bag, but one thing that surprised me when we were looking at this, and I've just highlighted here the occupiers. If we look at the dark blue and the green, it's the occupiers who are more positive about the world compared to the investors and developers. Now, yes, they're not as positive on life as they were for the first census 3 years ago, but nevertheless, still relatively favourable business conditions for the occupiers who completed our survey. And this feeds into some data we have for the UK. Sadly, we don't have this as a pan-European data set yet. It'll probably be my career's work to get data as good as this across Europe. But for the UK, this is an interesting story. We track every single occupier requirement in the market. And what we've observed is that there's pretty much a 9-month lag between requirements and take-up. And if we look at the dark line, that's our requirements index. And what we can see here is that at the back end of last year, we had that low point, the trough. In the first half of 2023, the level of requirements has started to increase from occupiers. All things being equal, this would point to take-up rising again in the second half of the year. And again, we've asked this question over the last 3 years. Are you expecting to take more space, stay the same, or decrease your footprints? And again, if we look at the dark colours, that's 2023. The lighter colour is 2022. And again, there isn't a big noticeable shift, a slight shift in occupiers saying they are looking to downsize. But again, broadly speaking, the balance of responses is still in that expansion, looking for more space type of mindset. And then we just looked at where people are looking to expand. And top of the list this year, Spain, Netherlands, Germany. And you can see the 2022 rankings there. The eagle eyes of you will note that this doesn't add up to 100%. We're giving people the option to tick multiple boxes and then grouping the results. But interesting nonetheless in terms of where people are looking to expand across Europe. Now, one of the questions we've asked people over the last 3 years is what concerns you? What are the things that are keeping you awake at night? Right at the top, rising rents, access to labour, the lack of new buildings, that lack of new supply, slightly fallen in terms of what people are concerned about. The availability of power, big increase in the occupiers saying that that's an important consideration to them as well. Slightly more interestingly, and I'm sure our panel will discuss this, implementing sustainable measures, ESG, not necessarily right there at the top in terms of the occupier mindset. Really interesting to debate this, to discuss this, see how that pans out with the capital markets. And I've got a slide that delves into that in a few slides' time. The next question we asked occupiers that I think is worth flagging is how do you intend to evolve your supply chain over the next 3 years? And then for me, there's a couple of really interesting things here that jump out at the results. Investing in automation, right there at the top. But if you look at what was really important in 2022, increasing the quantity of stock held. So, this was right, coming out of the back of COVID, rising inventories, this was all talked about. It would seem to me that the results of the census are saying, well, actually, that increase in stock holding cycle is probably coming to an end now, and we're looking back again at efficiencies. Nearshoring, reshoring is still there, but is that bringing manufacturing closer to home rather than actually having bigger inventories? So still a property impact, but a slightly different one. And then slightly conversely, people are saying, well, actually, we're looking to decarbonise our transportation supply chain, not necessarily our real estate. So interesting, dichotomy coming out of the results here. And again, we asked people, what technologies are you investing in? And if you remember 2 slides ago, we said that the importance of energy and power was really important. Well, what are people investing in? EVs, warehouse robotics, automation. So again, all power hungry, all need connections to the grid, on-site renewables, all of that sort of thing. Now, it isn't just an occupier survey, it is our logistics census. We ask investors questions, we ask developers questions as well. We asked developers a whole myriad of questions, but I just thought this one was quite interesting in terms of what's concerning our developer audience. And potentially, no surprise, the lack of development sites and the length of the permitting process. In reality, I think we could probably ask this question forever and probably get a broadly similar result. But what we're going to bring out from our panel is, are there any areas across Europe where best practice can be identified? Are there any markets that perform in slightly different ways? How are developers reacting to ESG? What's the impact of capital markets on development finance? All of this type of stuff. So some really interesting analysis that comes out from our developer audience. Moving on to capital markets. Again, this is the quarterly time series of investment volumes across Europe. And this is just broken down by country on a quarterly basis. And you can see, again, Q4 21, almost 25 billion euros invested in one single quarter. Q1 of this year, just 5. So again, Q2, surprising on the upside, trending upwards as a bit more stability returns to the market, people understanding how things are shaping out. And again, we'll talk about where that's heading in our panel. And then this is just our prime yield series. We've put a few key markets up there. And again, trending upwards to 5.2. Where is that heading? Where is that going to settle? I'm sure our panel will bring that out. But again, we asked some investors some more questions. What are the most important things for you when you're looking to deploy capital? Location, achieving rental growth, covenant strength, and there's that dichotomy I mentioned about ESG. Right at the very top on the capital market side of things, not necessarily the same on the occupier side. And then one of the questions we asked was, where are you currently invested? Where are you looking to invest? Germany, Spain, the Netherlands, Western Europe, Nordics coming out particularly strong as well, which for me has always been an interesting market in terms of the supply and demand dynamics and the growth potential there. So to wrap up, a very whistle-stop tour of the census. We get thousands and thousands and thousands of data points. We could talk all day on it. I've distilled it into less than 15 minutes. What we'll now do is I'll hand back over to Richard. We'll have our panel discussion. As I said, you'll get the slides, you'll get the report that goes with it. Richard will chair the discussion, and please do think of some questions you'd like to ask our panel. So thank you very much.
Thanks, Dan. Super, thanks, Ryan. And if the speakers could come up now and sit in whatever order you wish, that would be absolutely fine. Thanks very much, Kev. That's really interesting. I think loads of things to unpick and unpack in that discussion. So lots to pick up in that. You are there as well. You're remaining, so we can also pick up some other things. So if anybody's also got questions related to that they want to give to Ken, then please do. Let's just start with very brief introductions. Let's start over here with you, Phil, if we can. Just to take a minute for those who may not know you, just to give a brief introduction of yourself and the company.
Yeah, so I'm Phil Redding. I'm the fund manager of Tritax Eurobox. For those that don't know, Tritax Eurobox invests in continental European warehouses, so not the UK, just continental Europe. And we're a listed company, listed on the London Stock Exchange, and that's a bit about me.
Super, thanks, Dan.
Excuse me, Dan Berry, Alliance Healthcare, international real estate lead, looking after properties across Europe. We're in 11 countries. My day-to-day is mostly UK, but I look after bits and pieces across different countries. We deliver drugs to everybody in those countries. Just as an example, we have 18,000 dispensary points in the UK, which we deliver to twice a day.
Super, great, thanks. Niek.
Hi all, my name is Niek, Niek Poppelaars. I'm the co-head of the logistics and industrial department in Amsterdam, the Netherlands. We are with 8 people in our team, and we are focusing on both the investment side and leasing side. So I hope to give you a bit more background, especially on the Dutch market.
Great, thanks very much. James.
I'm James Markby, founder and managing partner of Logistics Capital Partners. We're a developer, logistics developer and asset manager specialist. We've got about 50 people across 6 countries. Development pipeline split 50-50 between the UK and mainland Europe of about 16 million square feet. And assets under management, in addition to the development pipeline, of about 13 million square feet.
Super, thanks very much. And I forgot to introduce myself at the beginning as well, didn't I? Briefly, I've just remembered that. My name is Richard Baird. So for those who don't know me, I'm the group publisher at Real Asset Media, and we publish a series of magazines, Insight, which they'll be at the front, and one called Real Asset Impact as well, which is focused around the ESG, social impact side of things. So interesting to pick up on some of the ESG points as well from that side. Maybe let's just start with the kind of general one. It would be interesting to get people's overall take on what they've seen here in terms of the census. James, maybe just start with you, if there's any kind of key things that you want to pick out of that.
I think it's a really good moment in time for this particular census, and the census being a kind of key, the key message. I don't know about everyone else, but it's been a period kind of wrestling with what is happening, what's going to happen, where does logistics sit relative to other investment classes, other asset classes. And it's one thing having kind of 4 guys in some backward-looking stats, but having a census of 250 market participants and a big chunk of that as occupiers, I think is particularly interesting as we come back from the summer break, particularly also because we've been living with 18 months of the most aggressive interest rate hiking cycle for a generation, and certainly for my professional career. And I'm pleased that the things that we were kind of, well, in one sense I'm pleased that the things we were feeling on the ground, and we'll probably touch on that there are some positive things happening, I thought was just unique to Logistics Capital Partners, because we're a great business, but it turns out there's actually stats that are supporting our sector and other people in it as well. So I think that's good news, and our practical experience would echo a lot of what's up there. Maybe we'll talk about some of the detail in a minute.
Great, Phil, maybe let's pick up with you as well. Any particular points that kind of stood out for you?
Yeah, just building on what James says, I think some of it was the headline of occupiers being more confident this year than last year was in some ways a little bit surprising. We're all aware of where the economies are going and growth, and we've all seen some of the statistics. But on the other hand, when you sort of think about it, it's not that surprising when you're looking at some of the long-term structural challenges that the sector is going through. So, still e-commerce is important. Building resilience into supply chains, which we'll talk about a little bit later, but also reducing the environmental impact of operations. These are long-term problems that will take quite a long time to actually resolve. So to have that underlying confidence and underlying the confidence to take on more buildings to solve those problems, on the other hand, isn't that surprising.
Okay, good. Niek, maybe from your point of view, especially coming from the Netherlands there as well.
Yeah, and I think we as real estate professionals, we are always comparing the years to the years before, so then we won't be too happy about it, of course. But yeah, once again, the point that the occupiers, the parties which really add the value to the real estate, are still very positive. Yeah, I think that's the main key issue of the census, the main takeaway.
Okay, and I guess, Dan, same question to you. It'd be interesting to get your perspective of it, because previously we've had different types of occupiers on this panel, so it'd be very interesting to get your perspective, given the kind of healthcare side.
Yeah, I mean, I think the thing about healthcare is it doesn't go away, and so our business is fairly stable. And we do have areas of growth, but which we need to cater for, and parts of the business are growing quite strongly. And it's interesting to see in the feedback on the census, the occupier side is the confidence that's coming through on that compared to the guys around us who are probably feeling a little bit more nervous, should we say, as things change. But from our point of view, we are reasonably positive. We are growing in certain sectors in certain countries, and so it's other challenges that were picked up about ESG and automation and power. They all ring true, and it's how we sort of work together that's going to be interesting with the different challenges and pressures that we have.
I mean, that's interesting because the power one came through very strongly, and certainly in the discussions we've been having, both in terms of the ESG and impact side, the kind of self-generation of power, those kinds of things, because obviously previously last year as well, there was a big focus on power resilience actually that hadn't come through before. James, maybe pick up a little bit on that side, the ESG side, particularly coming through. What did you see there?
There were two things from the occupier side of things that I thought were interesting. One, that generally they felt there was more better business conditions as a standout, which I assume meant their underlying businesses. And I guess the flip side of that question, this is one back to Kevin, is could they be talking that they think they're going to get cheaper rent deals and softer leasing environments? So I think that probably just needs to be clarified. The other one of the points that stood out as well, that ESG looked like it was lower down on their concerns, or a lower area of investment versus some of the other topics that were there. I think that's an interesting one to just draw out. Our experience is that for any of the larger requirements that are out there for newer buildings, and I'm talking kind of 40,000 square metres plus, but certainly anything in the kind of 75,000 square metres in these new big hubs, ESG is right at the front, and that's embodied carbon. That's what is in the physical build, that is in the operation, and then that is in the supply chain that feeds it. So it could be viewed as slightly disappointing that had fallen down the ranking in the census, but from our perspective, it's up there right with all the other topics. We are having those requirements demanded of us, and I think we are also trying to get on board and drive that agenda. I think about 50% of the carbon problem in real estate is in the embedded materials that are used. I've spoken on a couple of panels over the last 12 months, and I think there is a huge amount more beyond where the regulatory environment is headed that can be done on the embodied carbon side of things for new buildings. So I'd encourage everyone who's online and in the room to just ensure that you're getting embodied carbon assessments done of your buildings. They're not very expensive things to do, and it will highlight all the hotspots of steel, concrete, cladding, external hard areas where you can start to mitigate, and then in the materials that you design and choose for future CapEx or for your full build projects, and then undertake offsets. There's only a few people doing that at the moment, and the whole room and everyone online needs to engage in that on every single project we get involved in.
Okay, great. So online, you heard that. Good. Dan, let's come to you on that, because obviously it'd be good to get your perspective from that. And I'm going to set a rule that nobody needs to ask or be invited to speak. You can just speak whenever you would like to. But Dan, let's get your perspective on that.
Yeah, I mean, it's interesting because the sustainability is probably after sort of the basics of how big is it, where it is. For us, it's that ESG or sustainability, whatever you want to call it, is right up there. Partly that's probably because our buildings are so old in some respects. So anything new, we're trying to drive that agenda, and it is interesting how the different approaches between an occupier and a landlord developer. Why the reasons behind it? We obviously want to occupy it and run it as efficiently as possible, and that comes down to cost to a certain degree, but at the same time, commitments to being net zero by 2030 in the UK. Well, a large part of that's going to come down to fleets. We've run so many vans and trucks and things, but in terms of the building, absolutely, it's right up there still.
I think landlords and occupiers are completely aligned here, aren't they? In terms of the bigger problem of an energy transition, I mean, the property industry's got a huge part to play in that, and that sort of frames this. But sort of underneath that, I mean, this is a sort of win-win for both, isn't it? I mean, the sustainability features that we're putting into buildings make running those buildings more cheaper. You are taking energy from PVs rather than the grid, and it reduces costs. So, but there's a double benefit here, isn't there? As whilst doing this improves, for Scope 3 emissions are 1 and 2, whatever it is. We're both trying to do the same things. Both the landlord and the occupier are trying to meet both their commitments. And it's pretty easy to see these. I mean, a lot of companies publish what their targets are, and as do we, and they're pretty much the same. So everybody is pretty aligned in what we're trying to do here. But it also has obviously the benefit of reducing cost, which from my experience, supply chains do evolve, and they always will. But from an occupier perspective, getting operationally efficient is something that is just always there.
And what are the measures? Go ahead, Dan. But it'd be interesting to get what the measures are that people are seeing as most important as well.
I was just going to say one small thing in terms of the sort of conflict's probably a bit strong word between sort of an occupier and a landlord in terms of the expectations on what we can do in a building. Because I think recently as we were looking at a lease, and I can't remember the landlord, I'm not going to mention it anyway, but what the landlords were expecting us to have to use. But we looked at it and we were thinking, how are we supposed to actually use the building? Because of the sustainability demands they're putting on in terms of changes. We're like, well, if we do that and we follow what you're suggesting, we don't think we can actually operate in there. So I think there's sort of a definite sort of clash there to a certain extent. I think it's easily resolved, but at the same time, I don't know where the drivers are coming from landlords and developers, but there certainly needs to be a meeting of minds in some respects on that sort of thing. Sorry, I can't remember what your other question was.
It goes to another point, doesn't it, about this difference. Another surprise in the census was investors, where it's top of the list, it's massively important. Then occupiers, where it wasn't so high, and I think there is perhaps from some investors it is almost going down and they need these certain features. Because they think that otherwise, if they don't have those, it'll be stranded. What they're slightly missing is the purpose of the building and who's in it, and operating from it. And I think both are, as I say, coming from the right place in terms of what we're trying to achieve. But clearly, there needs to be a little bit of meeting of operational priorities, and also putting in the features, which may mean over time or certain things first or whatever. But I think the general direction is still aligned.
And Kevin mentioned in his sort of part of the presentation there that for some of the occupiers, actually the sustainability of the real estate side was less of an issue in a way, less of a priority, I suppose, than the transportation side. How do you see that? Where is the balance there?
I suppose the biggest source of this sort of CO2 is from transport by far, and I think if we can solve that, then it's almost the property side is great. It's just making sure we continue to operate in a sustainable manner, and but solving the vehicle usage and electrification, if that's the way it's going to go, is going to be the absolute key. But the problem is that comes with its own set of problems, because we talked about power. How are we going to power these vans? We've got 1,000 vans. If they suddenly go electric, they've got to be charged at some point. There's not enough space on the current estate. There's not enough power to do that. Some of the van drivers take their vans home currently, and we don't provide them with a very long extension cable to run from the top floor flat to their van. It's just completely impractical. You can't do it. So, and also then you've got the range issue at the moment. In the winter it's not as far as it is in the summer. And the load. There's so many different problems. It's tricky. Very tricky.
But ultimately, it sounds as though whatever happens, you're going to need more renewable green energy on site. In essence.
Absolutely, yeah.
And Nick, what's the situation in the Netherlands? I mean, let's pick up on this ESG point first, because the Netherlands is often a front runner in that. But then I'd like to switch a little bit as well to what you're seeing in the investment market then.
Yeah, just to come back, I think, of course, all the big corporate companies, they have the ESG demands of wishes on the top of their list. But of course, there are also some smaller national, regional companies which maybe has it a bit lower on their list. And to add on that, when you have only a vacancy level, for example, in the Netherlands of roughly 2%, then I think the main thing for the tenant is that they find some kind of a solution to run their business. And then ESG, maybe, of course, they are doing everything on it, but maybe it's not on the top of the list. So maybe that is partly an explanation of why it's not on the top of the list of the occupiers. And yeah, on ESG, indeed, power is top 1, 2, 3, 4, 5, everything. What we see in the Netherlands, indeed, the generation of power and also the storage of power is being done on site. And next to that, we see, for example, some initiatives like internal grid solutions, so that some developers or tenants, landlords work together. Several assets are on an internal grid next to the grid of the municipality of the government. Yeah, just to get sufficient power, because in the Netherlands it's not possible even to get a connection to the grid. So yeah, that's why I think it's the power issue is at the top of the list.
Okay. If we bring all this back to the relative performance of logistics versus other asset class and where it sits in the investor world, the developer, the occupier world, I think part of this census is all about the relative performance of this sector versus other investment classes or occupational classes. And ESG is an area being driven, I think, by investors to a certain degree at the moment. It's an area where investors need to compete and perform. You want to be in the top tier of performing buildings, you want to be in the top tier of quality. We're back to narrow definitions of prime, we're back to fundamentals. So that's an area we can all be focused on that looks good. It's an area of relative performance because we've still got rental growth. We've got, whilst we've got rental growth, we've got serious cost savings that we can drive through technology and also sustainable energy, private wire systems and solar panels that you can offer the tenant and really reduce kind of core business activities for operators. Also with the electrification of fleets, you've got I'll come on to it, but you've got the potential to provide more and more of that servicing on larger and larger logistics sites where possible. So fundamentally, you've got all these drivers that are making the sector look good for all of the three parties concerned, and I think that's why there's probably more positive sentiments coming out of this census than the rest of the macro environment might suggest.
And Dan, just thanks for that. And Dan, just to you, I mean, we've mentioned here a lot about changes that are happening, new things that you're having to deal with, challenges. Do you think at the moment the real estate component meets all of the needs that you have going to the future, or are there things that you're particularly looking for where the real estate side has got to kind of catch up in a way?
I mean, as we move towards more automation, it comes back. I keep going back on to what we've already talked about. It's hard to, it all links together. Talking about the power, that just the demands on that just increase. But actually, the fundamental buildings, they're being built to the right specification, and they be able to present back to through an approval process back to a board, and demonstrating that the right materials are being used, they're sustainable, it's built out of trees that were ethically grown in Norway or something. Putting that on it all builds up to that picture, and it then passes on to, we can say in our literature that we publish that we are occupying buildings that are sustainable and created in the right way. So, yeah.
Okay,
there's a fundamental tension though that we're all battling, I think, which relates back to politics at national and local level, and that was one of the points of sensitivities that was touched on, or concerns that was touched on, delivering of permits and consents. There is just a blanket resistance and growing difficulty to be able to deliver buildings, and then in particular large buildings. The irony of that being it's the large buildings and the new buildings that are going to be able to provide efficiency, reduce the carbon, and you can really go to town on and make a meaningful difference at scale. And yet politically that's where at a local and national level there's real difficulty. And then there's huge difficulty in having investment in the necessary power infrastructure. So we've got a scheme in the UK, it's one of the largest potential new logistics parks, where we've got a development consent order for 8 million square feet. So we've got the capacity for 150 acres of PV panels. So we can do a phenomenal amount of sustainable energy delivery. The grid doesn't have the infrastructure for us to be able to put that renewable energy back in. So you're then left with this debate with this huge capacity, a willingness from all parties and occupiers to do it, but not the national infrastructure existing to benefit from it. So I think there needs to be a reconnect between the sector and the industry and politicians, and how you actually drive and make use of I think industry moving needles on the power, on the solar energy and green energy supply.
Okay, good. There's certainly, Niek.
Yeah, maybe also to add on that, we see that as well. And the thing is now, 1.5, 2 years ago, the margins for the developers were a bit bigger than they are now. So at that time, they also had the money and to invest in that innovations and that kind of techniques. And now we see, of course, the market has shifted. We see that the margins are thinner. So I think that it will be another hurdle to make that innovations happen on a short term.
Okay, good. I wanted to pick up a little bit on some of the interesting things around expectations as well. Phil, maybe coming to you, I think it was, if I wrote this down, 39% of occupiers expected their take-up to increase compared to 25% a year ago. So I suppose, are you seeing that? Is that what you're seeing in the market as well, that kind of expectation, Phil?
Yeah, I mean, let's be honest. We've seen the stats, haven't we? So we know take-up is coming down, but coming down to more normalised levels. So, again, I think from the logistics sector point of view, that is pretty good. I mean, just on a slightly different point, normally in the cycles, what really derails things for us is the supply side. And again, Kevin put up the chart on vacancy. I think that is the really important one in terms of the market fundamentals for what all of us are doing up here. But back to, as I sort of said at the start, I mean, in a way it was a little bit surprising that was confidence. And let's face it, the first time in any surveys that I have seen, the property sector is not as optimistic as another sector. I mean, that's got to be a first. But it was a little bit surprising. But again, I mean, going back to, we picked up on some of the themes already. There is a lot of problems for the industry to solve, and there is in terms of the supply chain that continues to evolve, and it will need to be investment will need to follow. So solving those problems will take a bit of time. That will create demand, wherever that will be, big buildings, small buildings, or near urban centres. But I think all these challenges, what that equals is a source of demand. And the very positive thing that was coming out of that is occupiers have had the confidence to actually take on more space and evolve their estate by taking new buildings.
I think that's interesting. And Dan, from your perspective, obviously, we've seen rising costs generally, and Kevin highlighted that a little bit. And of course, we're not going to discuss hugely the interest rate cycle here, but that was plainly a shock and has been. But I guess, what are you seeing at the moment? Are you seeing a lack of supply for you in terms of the real estate that you're looking for, increased costs? I suppose, what are some of the challenges there?
Cost is always a challenge. and the good thing is it's trying to educate sort of the finance industry within the business who are not, they're not working real estate. So that when you see interest rates going up, their expectations are great. There's going to be a lack of development. That means rents are going to go down. Trying to explain that that's not the way of the world in property is quite hard. You go through that process, and you have to just educate the people in the right way. But we occupy things as small as 3,000 square feet up to 250,000 square feet, and so but the challenges seem to be the same. There's a complete lack of supply, and obviously everyone's very location specific. But if you go some places, we're looking for a small thing in the UK in Stowmarket. They've got a report back of supply in the area, and it was almost like, right, don't put anything in Stowmarket, make sure it's a big circle away from it. I know it's a very small town, but it was still, probably 5 years ago, you might be even a small shed would have come up somewhere. But that's the same for larger requirements as well. It's just not the choice.
I can't think of a single year or a single thing that improves that supply constraint. Year on year, from a developer's perspective, everything is stacked against you. You know, I think developers are relatively resourceful, to put it politely, people, and you know, if we can build warehouses, we will. Speaking generally, and it just gets harder and harder and harder. The frustration is within the teams at individual micro location levels. We just can't provide the volume that we are set up to do, that the equity wants, that the occupiers want. And I can't think of a single factor that's going to improve that situation.
Well, then it comes down to the point about compromise, doesn't it? You know, in terms of if you find something on the secondary market that's not got the sustainability credentials, but what's more important, the fact it's got an EPC of A or C, actually we need to run the business.
Yeah.
So we'll take the one that's got a C or the equivalent.
And would you then seek to try and upgrade that, for example? Would that be something that you would then be asking the investor to?
We'd try to, certainly. That would be part of the conversation. But at the end of the day, if it's only building you've got and it's only one around, then the landlord goes, well, you know, just maybe the more unscrupulous ones than the ones around us here might just go, well, if you want it, take it. Yeah.
Okay, good. I wanted to pick up a little bit on what the investors had said in the survey as well. And Nick, 76% of investors in the survey said they wanted to allocate more capital to the sector by the end of the year. So I guess, does that match your expectations for the year? And I suppose, how are you looking at that in terms of volumes, I suppose, and your thoughts going into 2024 as well?
Yeah, I think the thing is, I do recognize it. I am talking to a lot of investors, and they all want to allocate more capital into the sector, also into the Netherlands. But still, due to the fact that the ECB interest hikes are, of course, they are stabilizing now, but still there is quite some uncertainty. So I expect, to be honest, that the rest of the year on the investment side stays pretty slow, and hopefully in the beginning of next year, when everything stabilizes, that it will pick up again.
Okay, good. And Phil, it would be interesting, I think, to get your perspective on that. And also, I think, just on, you know, the stock building part was quite interesting, I think, there. And obviously, we've seen e-commerce levels stabilising rather than continuing the exponential growth that they had during COVID. So do you think we've kind of got beyond that? And are we now looking at drivers like nearshoring, friendshoring, those kinds of elements to actually take the business forward?
Yeah, well, just on the investment point, I mean, I think what you've got to, I mean, over the last year or so, and it's just been all macro driven. The uncertainty that the rapid rise in interest rates has put into the market has meant no one really knows where valuations were going. So until we get more stability and visibility on where that is going, I think investors will be really cautious. I mean, I think the good news is we are getting a little bit more stability and a bit more visibility on what that's going to look like. So I think that will mean the investors will come back. But I mean, look, I mean, one of the main points there has been the rapid adjustment in values, isn't it? I mean, unlike the GFC, which took 2-3 years for assets to adjust their pricing, this time round it has been really quickly. So it's been painful in terms of asset valuations, but on the positive side, it means that will mean liquidity will come back into the market much quicker rather than an extended period of nothing happen with a big difference in buyers and seller expectations. Coming back to the point on the building up stock in supply chains, and I mean, you know, at Tritax Eurobox, we saw this. One of our big occupiers took a big building through LCP to do just that. And I think as an initial reaction, that's the easy one, isn't it? Just, you know, to solve an issue, just get more stock in more warehouses near to the end consumer. And I think that will continue to have a part to play in the mix. But the solution will probably be a mix of things. I mean, getting greater diversity into the supply chain to avoid disruptions that were experienced just a couple of years ago. I mean, I think all major international logistics players will be looking at doing that. It will be different for different occupiers, I'm sure it normally is, and putting stock near, building up the inventory near consumers will be part of that. But there'll be other things as well, and nearshoring will undoubtedly be part of that mix. I mean, we've been talking about nearshoring for quite a while, haven't we? But it is now becoming a little bit more real Manufacturers, in particular, sort of difference in surveys now with manufacturers. This coming up quite a lot. So I expect to see more of that, but I expect to see that in a mix of various things that will try and increase diversity and increase exposure to a single point.
Okay, good. There's around 10 minutes left, so if anybody has any questions, do shout them out.
Can I just chip in on the investment?
You can.
Investment point. I've got a view on that as well. Just to kind of remind everyone where we are, because it seems surprising that the investment volumes are as low as the 2020 Q2. So 2020 Q2, the peak of COVID fear, and I remember being kind of locked at home with no time horizon in a completely unknown world, thinking where with a mask on when you go out, and where is this all going to end? The trading volumes are as low as that period of peak social fear, and this is a cycle that has been created and driven by high inflation and self-inflicted central government or central banking rate rising, which is controlled and known. The next nearest kind of shift in movements of the GFC, but that was a complete implosion of the banking crisis, which was out of control at the time. So you'd like to think, whilst this is uncomfortable, and we're kind of taking the medicine for what has gone before in the bailout and stimulus of monetary supply, it is in a more controlled environment, and it does feel like a bit kind of oversold from our perspective, or from my perspective at the moment. I'm not a macroeconomist though. And I think, as I said before, I think all the relatives of the underlying fundamentals of logistics stack up very favourably versus any other asset class at the moment.
Okay, good. I've got a couple of questions online, and if there's any questions you've got, let's pick up that, and then I'll come to you guys online in a second.
Just on the investment side, panel. It seems to me that across Europe, Germany and other places in particular, owners are still not willing to trade at levels that are probably more appropriate these days. They keep looking back to where the markets were when interest rates were a lot lower, and just don't seem to have actually followed up rationally. I think I saw a chart not long ago showing the differential between prime yields and I think bond yields was averaging about 3%. It's narrowed now to about 1.5%. Because a lot of owners are not willing to accept lower pricing.
So just in case that wasn't clear online as well, the question there was about pricing and the difference in expectations, I guess, between buyers and sellers. Does anyone want to pick that up?
Yeah, I think you're absolutely right. They're still in continental Europe in particular. I think UK has adjusted much quicker, and you're seeing those transactions taking place at sort of 5% plus yields. It's not unusual for continental Europe to be behind the UK. It was last time, it is this time, but the adjustments are coming through. So as an example, Tritax Eurobox sold an asset in Germany very recently. We had 50 investors sign an NDA, and we traded that really, really quickly. It was a very high quality asset, so I think investors are pretty selective, and there are some owners who are willing to trade at these sort of levels. It's sort of few and far between at the moment, but that evidence is starting to come through. So it's a little bit slower, but I think it will follow in those markets as well. So the adjustments will come through as the evidence comes through.
Yeah. No, I totally agree. I'm quite positive on that. That we all see it coming now. So hopefully it will really pick up by the end of this year, beginning of next year. We see it coming closer, definitely.
Picking a counterparty at the moment is almost, in terms of vendor, is almost as fundamental as picking the right plot or asset to go for. I think that a lot of people are wasting a lot of people's time at the moment. And there's a certain amount of medicine that does need to be taken across the sector, but I still think there's a lot of profitable business. It might not be quite as super profit, but we just need to kind of get used to that. It's still good business.
Okay, good. I'm just going to pick up some of the ones online, and if anybody else has got a question, do let me know. Ian, thanks very much for your questions, Ian Morgan. He's picking up a point around ESG, which is it really the institutionally backed businesses that are much more focused on it being fully ESG compliant and those kinds of things, and maybe those that aren't backed by institutional capital are less focused on it? Does anyone have a view on that?
Yeah, I'll kick up. That's probably off that. The thing is that when you're looking at the ESG on a building or still putting in sustainability, it's all about collaboration with the occupier. You've got to talk and you've got to communicate and find out what is needed, and then work with the occupiers to actually make that happen. It's very different if you're not as connected as maybe an institutional investor, say, and just looking at a piece of paper with credentials and then sort of demanding certain things actually happen. So, for me, you've got to talk to the occupiers of the building and work with them to deliver this stuff, rather than just see it as a paper exercise.
Okay, good. There's also, Christoph has come in with one. I have a question concerning PV in large scale, so obviously solar, on large scale projects. What are the challenges to put the energy back into the grid in the UK and the Netherlands? Is it an option to do things like, hydrogen and those kinds of things? I don't know whether anybody has a quick view on that. That's almost half a conference. Yes.
No, indeed, that is a big problem. To get any power back on the grid is nearly impossible in a lot of areas in the Netherlands. So therefore, large battery storage and that internal grid story I was just telling you about are some of the solutions we see in some part of the Netherlands.
Okay, great. And we've got a series of very quick ones here. The zero net land take in 2050 suggests there should be more verticalisation, it's put here, but obviously high rise as well as automisation. Are we already seeing signs for that? Hold on to that thought. How are your markets affected by the introduction of zero emission zones and the lack of car drivers and CO2 and toll pricing may bring trains into a more important position? Are there already signs of these things? So if anybody's got a view on any of those three in terms of the transportation side, especially in those kinds of things.
I've got a view, mainly because, well, this is a UK-centric view. I think it applies elsewhere, but we acquired a site 24 months ago that has West Midlands Interchange, which we're about to launch next month with consent for 8 million square feet, and also an obligation to build a rail freight terminal, which we had never done before, and so we had to get up to speed on rail freight terminals and operations pretty quickly. We can save with a rail freight terminal that has somewhere between capacity for 5 to 10 trains a day, which is very similar to a couple of the other big new logistics parks with rail freight terminals. About 1 million metric tons of carbon emissions can be saved through the rail freight terminal per annum, which is massive and is far more than the real estate component of carbon emissions. So I think at a political and investment and then kind of individual investment level, that is the way the market will drive towards if it's available. The level of interest which was in greening of the supply chain and finding capacity off the roads during and post the COVID era clearly demonstrated to us that is the way the market is going. The challenge again is politically and just in terms of supply, where can you actually deliver these things? I think there's more going on in the UK in terms of new rail freight hubs being created than we see elsewhere. So I think that's important. I think scale of logistics parks as well, rather than 1 or 2 buildings. If you can build multiple building parks with PV on it, even if you can't sell it back into the grid, one of the solutions is then to work on your knowledge and ability to actually create private wire infrastructure and create on-site demand. So by providing EV charging and other facilities and amenities across a managed park, you can create additional demand that doesn't have to go back onto the grid in your park, and then you start to have to investigate battery storage. So all of that starts to link together, but it all goes towards scale and investing in your national infrastructure for power.
Yeah, and we're beginning to see some interesting solutions as well that for self-generation. Yes, very quickly.
Yes, I'm Tom Bird, one of the directors here at Savills. I wanted to understand, we talk a lot about stock and sustainability today, but down from your perspective, like lots of people, you've got stock which is new and not so new. And how important is to you and how more efficient does it make you by making that older stock up to today's standards?
So I thought you were talking about stock in the building for a second. I was like,
Sorry.
what? I can't answer that. Yeah, I mean, we'd all like brand new shiny buildings that are sustainable, but at the same time that cost is just so vast, we couldn't suddenly change overnight. I mean, some of our buildings go back to the 70s, which we'd like to get out of, but the margins on the business just don't allow it at the moment. There will be changes, and different parts of the business are growing differently. We've just taken new space in south of Madrid, about 40,000 square metres, all brand new, shiny, ticks all the right boxes. But equally, trying to move something in the UK, it still works as a building. It still does what it needs to do. Could it be done more efficiently in a better building? Yes, but actually, the costs, the benefits aren't there yet to justify the move. You're still working something that's slightly less efficient, and lack of automation, you still use people because the cost of changing is so high. I mean, if you want to invest in automation, you're talking tens of millions. You've got to justify that over a short period. It's hard to do.
Yeah. Just very final question. Thank you for that as well. A very final question, which is obviously we've noted some quite big changes actually in terms of the census there. So 10 seconds each, maybe 15 at a push, on what you see as the biggest change. If we look at this next year, what are you seeing as the biggest change that we expect to see in this space in the next year? James, 15 seconds, go. That's 5 seconds gone.
Shortest time scale for the question I was prepared for. I think some of the reorganisation of investors and developers and personnel changes actually will shake things up and re-establish a new order of who's dealing with who and who's delivering what. It's that old adage of when the tide goes out, who's been wearing their swim trunks or not. And I think that will become exposing for some and allow others to stretch their legs and gain market position.
Okay, good, Niek.
Yeah, I think in particular for the Netherlands, as from 2025, the zero emission zones in the 30th biggest cities of the Netherlands will be enforced. And with the lack of power and everything combined, I'm very curious to see what's going to happen in the coming years. Of course, the tenants are preparing themselves, but they don't see a solution. So hopefully the government. Hopefully, I expect that the government will how do I say it? That the government will say, okay, 2025 is not reasonable. They will just extend and adjust timelines, I think. But let's see.
Okay, Dan.
That's the longest 15 seconds I've ever come across. I'm going to keep it very short. I think the lack of supply is going to be our main concern.
Okay, lack of supply.
Yeah.
Well, I can tell you what won't change is that high quality buildings and high quality income will still be good investments, whether that's last year or the coming years. So that's not going to change. I think that the big thing, what has changed, hasn't it, is the industrial logistics sector has gone through a huge challenge with the rise in interest rates and the macro economy. I think that will stabilise, and so the big change will be a much more better picture going forward.
Great, thanks very much. Good to finish on a positive note there as well. And actually, overall, I think the census was more positive than I was expecting, which was interesting for me to see. Thanks very much for all of the questions online and all of the questions here. Really interesting. You'll be able to view this on demand if you want to, and everybody will receive both the census and also the presentation when they kept. So that's great. Thanks very much for joining us. If you join me in thanking the speakers and Kev, that would be great. And if you're watching on this on demand, thanks very much for watching. Thank you.